Hi again, once again, everyone out there in FFG land. Kelley Goodwin from Sacramento. I've got my regional assistant Jeffrey Hamill, Joshua Hess, and Stuart with me here today. And what we're going to do is talk about some of the key benefits of the Index Strategy Universal Life Insurance Plan that we use primarily with our clients. Now, first of all, I want to make sure that I support your regional managers and your DMs, and obviously Federal Financial Group when I say memorize your script. For the vast majority of the people that you're going to work with, the information as you present it in your second presentation is going to be more than adequate for closing the sale and getting people to take the next step forward. I'm going to cover some of that information with you today, but I'm also going to give you some additional information that if for some reason you're dealing with higher net worth individuals, people that have more questions and more analytical, you can maybe pull some additional information out of your hat, so to speak. Make sure that you confirm all the information that I'm going to show you today with your manager and make sure it's okay to use it. But these are some of the tools that I use in my presentations as well. So that being said, let's get going. First of all, the key benefits of the IUL, as we know, are winning the tax battle and winning the rate of return battle. Going through the second presentation, we're going to start out with an outline where there's only three ways that money can be taxed. This should look familiar to you. We talk about fully taxed, tax deferred, and tax advantaged. Now, when you're presenting this to your clients, obviously we use $10,000 so that we can see how the numbers work. We talk about a 10% return, and that's going to be added to your income tax at the end of the year. So if between state and federal taxes you're in a 35% tax bracket and you've had $1,000 of gain, that means that you're going to lose to taxes 3.5% of that 10% return. We're going to lose $350. You're going to net $650, and that gives you 6.5% net rate of return. Now, obviously, we'd rather not lose the 35% to taxes. Now, tax deferred, the reason why people like tax deferral is because we don't suffer this loss. If we had the same $10,000 invested, you would have $350 more money growing for you each and every year, right? Now, in this tax deferred column, the type of tools that people commonly use are IRAs, 401ks, 403bs, 457s, etc. But remind your clients when you're talking to them, these aren't actually tools, these are laws. These are sections of tax code that talk about how money is treated at different points in time depending upon your age and maybe if there's an emergency need like that, there might be a loan provision. The point is that all the money that you're putting aside, even that it's going in tax deferred, notice that name. I like using this a lot. Mr. and Mrs. Client, that name doesn't say tax never, it says tax deferred until the pot of money is bigger and taxes are going to be even bigger. I actually like to use the analogy of a pressure cooker, okay? Now, tax advantaged investing, what is this? Well, again, tax advantaged investing is a section of tax code that allows us to put money aside. It grows tax deferred like the IRA or the 401k. However, when the money's coming out here at some point in time, it comes out tax-free. Also, I like to draw actually a dashed line here, and I say there's a difference between that line and this solid line, and let's say this is 59.5 for most people that were born actually prior to 1964. The qualified plan retirement age is 59.5. After that, it starts going up in 2-year increments, 61.5, 63.5, etc. IRS can change, or I should say Congress can have IRS change those ages at will. Now, 59.5, money comes out of the qualified plans with no penalties, only suffering regular taxation. Again, here's a problem. House is paid, right? Kids are gone, got grandkids. You spoil them on the weekends, you send them home, you're not raising them. Maybe if you were a business owner, you've already sold the business. Where are your tax deductions? 100% taxation from $1. Most of your clients are going to answer the question, if you say, do you think taxes will be higher or lower in the future? They'll say, well, obviously higher. So basically, you're putting aside money in the lowest tax bracket and you're pulling it out in the highest tax bracket you're ever going to be in. Plus, add into that inflation, that means you're pulling even more money, so you're being hit even harder and harder, and every year it gets worse. Now over here, we draw this dashed line because we can pull money at any time for any reason, totally tax-free and penalty-free, out of these tools. So Mr. and Mrs. Client, if I'm able to pull money tax-free, and even if there's inflation and I'm pulling more and more and more money, but I'm suffering zero taxes, so we have a growing tax bill here, we have a zero tax bill here, and actually a growing tax benefit because we're pulling more money, which makes more sense. Obviously, they're going to say number 3 at this point. Now, once we finish this, we're going to go and talk about that there are only 3 ways that we can pull money legally in compliance with the tax code so that we can get the tax benefits we want. Now, we need to win both the tax battle and the rate of return battle. Okay, so on the tax battle, there's only 3 ways legally to do it. The first way is by using municipal bonds. So you ask them a question, have you ever heard of municipal bonds? Most people have. If you're back east, you have the toll roads and the toll bridges, okay? Out here in California, we have a great example we like to use is how comfortable would you be with loaning money to Stockton? And Stockton just went out of business, or they filed bankruptcy, should I say. So with municipal bonds, on the tax battle we win because the municipality is going to pay us interest, state and federal tax-free. We get any growth back, of course, tax-free. The problem is it's a very low interest rate, somewhere between 2 and 5% on average. Again, if they don't go bankrupt. Now, on the rate of return side, we lose, okay? Because we've already talked to them about compounding interest and how 1% difference over the long run can mean hundreds of thousands of dollars of difference in your retirement. It's critical that they earn that. Now, the second way that we can put money aside to win that tax battle is by using a Roth IRA. Now, with a Roth IRA, it does grow tax deferred and it comes out tax free. We win on the tax side, but there's some limitations based upon our age and income on whether or not we can use this. Sometimes we're working with people that are a lot closer to retirement than others, and it's really not going to allow us to put enough money aside to do what we want to do, okay? At the same time, most of the Roth IRAs out there that you're going to be able to find are going to have those variable tools in it, stock market-based tools, mutual funds, things like that, which means there could be something, there could be nothing. Now, the third and last way is by using illegal blood diamonds from South Africa. Just kidding, it's a joke. I like to say that because a lot of people that I work with, sometimes people have this funny feeling about life insurance, and it just kind of makes them feel uncomfortable. Josh, I'm sure you've had that once in a while, right? And so the thing is, you want to laugh a little bit and say, just kidding, but I really do have a bucket full of them in the car. But here's the thing. What we like to use is something called investment grade life insurance. How do you feel about life insurance? I like to get this out on the table. I want to know if someone has any preconceived notions about life insurance, any bad experiences, because I don't want to be surprised at the end. I want to know and be able to address those problems up front. Investment grade life insurance, what it isn't, Mr. and Mrs. Klein, it's not term life insurance. Term life insurance is a great tool. If you love someone, have a limited amount of money, if you have a business, you have an obligation, a debt, maybe on a loan that you need to cover, you might need to have that. But if you have enough cash flow, and depending upon other resources you might have, you don't want to use term, you want to use something else, because it doesn't win the tax battle, it doesn't win the rate of return battle, there's no cash buildup. I like to use a funny story. I'll say to my clients, say, Mr. and Mrs. Client, let me ask you a question. Let's say I've known you for 20 years. We're best buds, right? I come over to your house one day and I go, hey, man, I found this great investment. It's like a 9,000% return. You know me, I'm not going to hurt you. Hey, would you like some? And immediately you think, 9,000% return. Yeah, that sounds pretty good. But there's two gotchas. The first gotcha is by age 85, guaranteed it's gone. No return of money, no growth, nothing. The other problem is, or potential problem is, 96% of the time, nothing is going to come back from all the money that you put into this investment. Mr. and Mrs. Klein, how much of that would you like to buy? Most people look at you like you've got three eyes and they say, well, I don't want any of that stuff. That's term life insurance. And then they go, oh, right, and the light bulb kind of goes off. So then you say, well, let's talk about what this is. So when it comes to investment grade life insurance, what it is, it's a type of permanent life insurance. Now, Mr. and Mrs. Client, the first kind of permanent life insurance that came out a few years back, actually over 100 years ago, was called whole life insurance. Now, have you ever heard of that? And they'll say yes or no, maybe. So now with whole life insurance, the thing that was so awesome about it is, for the first time ever, over 100 years ago, when something happened, there was life insurance on the day that you died, the day that you needed it. It was kind of neat. It actually helped us create our entire country around us. Research, hospitals, schools, you name it. So the thing is, whole life insurance is a great tool. Now, basically, ever since the beginning of permanent life insurance, all of the cash buildup inside of it was tax deferred. You can access the money tax-free via policy loan. So in addition to providing a death benefit to protect your family, now business owners could grow money, use it to expand their business, buy a piece of property, etc. Walt Disney used cash value out of his whole life insurance to start Disneyland. There are many different examples of this. So whole life insurance wins on the taxes, but the problem with whole life insurance is that the growth that comes from this is from dividends, not from interest. So at the end of the year, the board of directors is going to say, give them something, give them nothing, whatever it is, within the legal parameters of the contract, and the rate of return typically is not nearly what it should be to win both battles. Now, the second kind is called variable universal life insurance. Now, with variable universal life insurance, basically we're taking a universal life insurance contract and we're poking a hole inside of the death benefit, and we're stuffing into it a whole lot of things called separate accounts. Now, back during the 90s, before I got religion, so to speak, and joined FFG, I actually sold a lot of these things. And I owned 3 of them before I actually owned my own index strategy contract. The point is that these separate accounts are actually not mutual funds. They're called separate accounts. Now, with variable universal life insurance, during the 90s, when the market's doing this, averaging 13.5% growth per year for 10 years in a row, hey, a few fees, maybe that doesn't make a whole lot of difference. But you understand, not only do you have all of the insurance costs and the policy expense charge and the premium expense charge, but you also have all of the fees that the mutual fund companies had, plus you had a licensing fee, because maybe you had AIM and T. Rowe Price and MFS and Putnam and all the rest. Now, again, these were very popular during the 90s because if it's going like this, again, who cares about a few fees? And you could buy, sell, trade, rebalance your portfolio at any time for any reason, no taxes. That was pretty important, wasn't it? Absolutely. Diversification, rebalancing, we all know those terms. The problem is, though, is that when the market starts coming down, okay, the fees start really hitting hard. And just as we know, and we talk to people about the fees in their mutual funds, and if the market's doing like this, okay, and because right here, from here to here, let's say that's a 10% loss, and then the fees in the mutual fund are an extra 2.5%, let's say, because of lots of excess trading, so forth and so on. They didn't go down by 10%, they went down by 12.5%. So that makes it even harder to grow money when the market goes back up. That's why these things ate themselves up when the market started correcting at the end of the 90s. So the thing is, variable universal life wins on taxes, but for the most part, it's really not going to win when you talk about rates of return. Now, the third and last way, the one that we like to use the most, is called an index strategy life savings plan. Now, with an index strategy life savings plan, remember, in taxes, all permanent life insurance, if it's properly constructed, okay, is going to win on tax-deferred growth and tax-free withdrawals via policy loans, staying within the tax code. Now, on the rate of return side, again, if we're using the index strategy, which looks like this, right, instead of like this, big difference, big difference. So I like to point this out, and I say now, Mr. and Mrs. Client, of these 3 ways, can you think of any way, other than what I've shown you, that I haven't covered that's going to win both of these battles? What do you think the answer is? No. Okay? Now, what we need to do is we need to find a company who has a product that is unique, that is head and shoulders above everyone else, and we need to see if we can't do some business with that company. So at this point in time, I'll say, let's talk about a company that we like to use called Aviva. Okay? And then you go into the history about Aviva, and all of you should know this, but again, Aviva's been around since 1696. They've done business with Winston Churchill and Queen Victoria. Napoleon asked for a policy. They declined, and the rest is history. Isn't that funny? I love that story. You know, Aviva actually insured Hitler's car collection when he invaded Poland. They canceled the contract. I mean, that's kind of funny. So the thing is that Aviva has been around for a ton of time. By the way, they insured the tea that was thrown into Boston Harbor with the Tea Party. That's kind of cool as well. Aviva is one of the largest financial services company in the world, somewhere in the top 6 or 7 at any given point in time, $700 billion in assets, and they make a ton of money in profit every year. So the thing is that Aviva came over to the United States a few years back when everything was on sale, you know, 37% off, right, 2 years after 9/11. And they said, what company is standing head and shoulders above the rest that offers American people the tools that they need, that will win the two battles, the tax battle and the rate of return battle? Well, there were about 10, 11, 12 companies at that point in time that actually had any sort of index strategy life savings programs. And Ameris Life Insurance out of Des Moines, Iowa was one of them. So they looked around, and at that time, Ameris had a 55% market share of all index strategy, life and annuity contracts in force in the country. So the thing is that they're the big dogs, right? They're the 800-pound gorilla in the room. And Aviva said to Ameris, you've got something we want. So we want to buy you. We'll offer you 20% above the outstanding share value that you have, but you got to sell to us right now. Ameris says, okay. So Ameris, after a couple of years, it changed the name, becomes Aviva USA Group. Now, Mr. and Mrs. Client, the company that I'm going to show you today is Aviva. And another thing that I didn't tell you when we first started working together is, unlike 47% of the mutual fund managers out there today, according to Morningstar, that don't put their money where their mouth is, I do. Some people find that pretty important. You know, I use this for me, my wife, and my daughter. I've had policies for over 8 years now, and it's the only tool that I use for my retirement, and I can have anything. So the point is this, is that Aviva is the product that I'm going to show you today. Then you pull out the illustration and you start going through it. Now, the first thing that I like to do with the illustration, and I don't have anything that I can put up here to show you, but the first thing we do is we take a look at the death benefit. We say, Mr. and Mrs. Client, first thing is, if something should happen to you, immediately upon proof of your death, income tax free, this amount is going to go and take care of your family. And I know it's going to be difficult for them because you're not there, but at least they're not going to do without the basics, right? So that's kind of important. Also, something else to note is, I didn't choose this number. When I was trying to put together this plan for you, what I did is I told the computer program that we use how much money we had to work with over a given period of time, and I asked it to construct for me the smallest tax wrapper that I could get structured around the money that we're putting aside over that given period of time. See, the goal is not to sell you a big life insurance policy, but it's to help you create a tax shelter so that you can grow your money tax deferred and pull it out tax free and maximize the efficiency. See, one of the problems that people have with the whole life products or with any permanent life insurance policy out there is that a lot of times agents really don't know how to properly construct and help you maintain these tools the right way. Okay? So if we do this wrong, then there's a problem. If we do it right, it's amazing what happens. So then I go through and I show them putting aside X amount of money, whatever that we agree that they can do on the F&A. And typically, if someone says, I can do $500 a month, okay, I don't like to make that the minimum. You want to leave a little wiggle room. So maybe you make the minimum $250 or $200 a month. And you show them how that will work out. I like to show at least 15 years of contributions and or 15 years of growth. Maybe sometimes 10 years of contribution followed by another 5 years of growth, depending upon the age of the person. Sometimes I like to see at least 17. The thing is, with compounding interest, these things work awesomely. If you don't give them enough time or don't fund them heavily enough, then they're not going to look really awesome at all. So We show the money going in, and typically if you have a well-designed plan, somewhere between 3 and 7 years into the withdrawal period, after the accumulation period, the client's going to see that they've received all of their premiums back, and then they're going to start pulling nothing but growth. And then you show them, okay, until your life expectancy of, let's say, 75, 80, 85, depending upon what they tell you, then you're going to show them that they're going to pull an additional 2, 3, 4, 5, 6. I've seen them as high as $1 million of income tax-free after they get all their money back. So at that point in time, you look at the client, you say, now, here's the thing. Let's say that when you're 80, 85, Mr. and Mrs. Client, you give me a call, and maybe I'm not around. And I mean this sincerely. I say, I think my daughter's going to end up taking over my practice. And my daughter has a strange sense of humor, and I'd like to lighten things up and just kind of keep it light at this point. And I say, now here's the thing. You call up my daughter, and you say, Kathleen, I just went to the doctor and I found out that I have cancer from one end to the other, and I'm not going to be around in 6 months. And my daughter, who's got a strange sense of humor like her papa, says, cry me a river. I mean, dang, you're 80, 85 years of age. You've been pulling money for 20, 25 years tax-free. You've pulled out $500,000, $600,000, $700,000, $800,000 tax-free. You know what, you're right, that is sad. But here's the thing. Notice that in addition to that tax-free money that you already spent, there's an additional $300,000, $400,000, $500,000 that you have access to. Here's what I want you to do. Call up your closest family members and your friends, right? Pay for an extended cruise. And here's the thing, when you can't stand it anymore, have a lovely dinner with them, get the best bottle of champagne on the boat, and then at the end of the dinner, now don't be a sob sister, okay, because I know you see how you be sometimes, right? But I want you to take that bottle of champagne to the back of the boat, take your pain pills, right? And just lean back. And you won't even feel it when you hit the water, right? So what did we do? We're being very green, all right? We're being politically correct these days. I'm just kidding, but you know what? Most people laugh at that. So the thing is that they think you're kind of nutty, it's kind of fun, but you say, what did we accomplish at this point? You had all this money tax-free. You had an additional ton of liquidity when there was an emergency to spend, and then when you passed on, your heirs got what was left income tax-free as well. Did I do a good job for you? And at that point they go, yeah, you really did. Mr. and Mrs. Client, there's a gotcha, I'm sorry. There's a big one, you're not going to like this. Aviva's huge. I told you they've got a 55% market share of this. They still have just about that. And the thing is that they're really strict on who they give this to. So you've got to qualify based upon your health and maybe on your lifestyle as well. So here's the thing, let me ask you a question. Have you been in the hospital overnight in the last 3 to 5 years? Tell me about your parents and your grandparents. Were there any hereditary disorders? Was there cancer? Was there mental problems? Was there diabetes? Tell me about those kind of things, right? Tell me about your driving record. See, all these things add to the takeaway, right? And then after you go through that, you're starting out on page 3, and then you work back towards the front. And if you get enough, I should say, knows that there aren't health issues, you can say, man, this looks really good. I think we got a good chance of getting you standard, preferred, premier, depending upon how they answer that. So what we're going to do is we're going to continue filling this out, and then of course follow the script and use that takeaway. And of course, don't forget to get checky wecky, okay? Because if there's no check, there's no deal. So that is kind of what I like to show and what I like to say to my clients. But in addition to that, I want to give you a little bit of additional information that I find really, really helpful. So first of all, if for some reason this is not enough information, or when you're going back in the third, to just make sure they're happy and answering any additional questions that they have, and pick up your referrals, which you deserve at this point, we need to talk about how you can do a comparison to traditional qualified retirement plans very, very quickly with a lot of impact. So here's what we're going to do. So with help from you guys with your calculators, because I don't have to do that on camera, is this. First of all, that tax-free income that you see coming out of that policy every year, I really like to draw a comparison between that money and the money coming out of an IRA, 401k, etc. So let's say that someone had $50,000 a year tax-free coming out of their index strategy life savings plan, tax-free. The question is, what is the equivalent income coming out of a fully taxable tool, like the 401k, the IRA, 403b? So here's the formula that you use to do that. What you're going to do is you're going to divide that tax-free income by the inverse, okay, of the tax bracket. So if the tax bracket is 35% between state and federal, you divide by 65.65, and that grosses up that number. So Josh, $50,000 divided by 0.65 is what?
76,900.
$76,900. So Mr. and Mrs. Client, generally speaking, if this money is taxed in a combined tax bracket or top marginal tax bracket of 35%, for you to net $50,000 coming out of the IRA or the 401k, you'd have to pull $76,900, lose 35% of it to net that 50 grand. Does that make sense? And they should say yes. Okay? Now at that point, I look at them and I say, okay, Kelley, I get it. I know that this is important. Tax-free income, yeah, I love it. But Mr. and Mrs. Klein, you're still not getting the full impact. I've got to have you understand why the guarantees make such a big difference. So the next step is, Mr. and Mrs. Klein, all financial planners, all of the books on money, all the websites, you go to them and you look up and you say, how much money can I pull every year, every month off of that portfolio that I have in retirement? If that's a non-guaranteed bucket of money, in other words, diversified portfolio, stocks, bonds, and mutual fund, maybe real estate as well, and going forward through time it's going like this, right? How much money can I pull so that I never run out of money before I die, right? Because it really sucks if you run out of money before you run out of time. Look at the people at Walmart, right? The gals working down at Wendy's. So here's the thing. Many times, and I've heard this from clients' lips, their broker has told them you could pull 10% per year. So obviously the size of that portfolio, if they could pull 10% per year, would be $769,000, wouldn't it? But here's the question. You pull 10%. How much do you have to grow the portfolio to break even? It's not 10%. It's more like 12 or 13. That's the problem. And if, God forbid, the market is down, when you pull right here, you have less money to grow the next year. That's the problem. All the studies show somewhere between 8 and 12 years, if we're using a non-guaranteed bucket of money to pull from, and you're pulling anything over at the absolute outside 6%, 8 to 12 years you're out of money working down at Walmart. Okay? So the thing is, 5% pretty much is guaranteed if you pull at 5% not to run out of money. At that point, and this happened to me a number of years ago, I had a husband and wife come into my office, and this is before I worked with Federal Financial Group, and he said, you know what, I almost have $1 million. He had about $900,000. And I expect within the next year and a half to be able to retire, and I'm going to pull 10%, $100,000 a year, right? I'm going to lose some taxes, I understand, and I'm going to net, 73, 74, 75, whatever. I think he was a little optimistic on that, but I feel pretty good about that. I went through these numbers with him, and I proved to him that he would only be able to pull 5%. That's $50,000 a year. I'll never forget the look on this guy's face. He started turning beet red, and he looked at me, and his wife's got her hand on his arm. He said, calm down, honey. He says, you mean to tell me that I worked most of my life, and I managed my money, and I worked, and I scrimped, and I saved, and I didn't do, and I did without, and my family didn't have all the kind of things I wanted, and you're telling me I'm going to pull $50,000 a year, and it's taxable, which means I'm going to net somewhere maybe around $37K if I'm lucky. And I said, yeah. But remember, I didn't do that to you. Okay? The numbers did that to you. Your broker did. I didn't do that to you. So here's the thing. Because we have the guarantees in the index strategy, and because your regional manager or district manager should show you that we're pulling sometimes as high as 12% income off of those accounts. Here's the thing. Josh, do me a favor. Divide $76,900 by 0.05, which will gross this up to see what someone would have to do in the qualified plan to equal what we're doing here.
$1,538,000.
$1,538,000. Okay? Now, the interesting thing is this. In comparing the numbers that we have in the index strategy life savings plan, the amount that we're putting into that as opposed to the amount that someone would have to put into these qualified plans, it's anywhere from half to a quarter what they would have to do to put aside into a qualified plan. And then on top of it, to make it a fair comparison, the client's going to have to go out and buy life insurance with after-tax dollars for the amount of life insurance that they're going to have at least until age 80 as a side-by-side comparison. So what I'm going to submit to you, everyone out there in FFG land, is practice and play with these numbers. Use this formula so that you can explain the importance of having a guaranteed portfolio to draw from and grossing the numbers up, taking into account tax brackets. It's as powerful. Okay, sometimes when you're in a position and you're talking to someone and you're trying to get a first presentation and you talk, you do the 30-second elevator pitch, hey, taxes and guarantees, and man, we got to sit down and I really whatever, right? So hey, listen, let me ask you a question. You got your phone on you? Okay, you got a 401k, and you want how much money in retirement every year? Just do the numbers. Do you realize that if someone is in a net effective tax bracket of 40%, for someone to net $100,000 net every year in retirement, they're going to have to pull $166,666, lose 40% of that to net that 100K? $67,000 a year in taxes, not including inflation going forward if they live any appreciable period of time. That should get somebody's attention. So the thing is this: be passionate, be enthusiastic, know your stuff, know the numbers inside out and backwards. Make sure that you know these calculations, right? And always talk with your regional manager. Make sure that he's okay or she's okay with the numbers or the kind of figures that you're using. And I will see you at the top.